Trading Options 101, the basics. Ready for your crash course into options? Awesome. Let's get started. What are options? Options are financial derivatives, or simply instruments that give buyers the right, but not the obligation, to buy and or sell an underlying asset at an agreed upon price on or before a specified date. Alright, stocks versus options. Now, what's the difference? An option contract represents 100 stock shares. Thus, think of trading an option contract in multiples of 100 shares per contract. One contract equals 100 shares. Two contracts equals 200 shares, and so forth. Stocks trade in shares, but options trade in contracts. Remember, options are assets. So like any asset, you must constantly think about what will make your asset depreciate or appreciate. Sometimes options are depreciating assets because time is against you. Time decay, theta, but options have extrinsic value. Thus, sometimes options can appreciate if unprecedented volatility occurs. We will discuss this further in the video, so stay tuned. You don't want to miss this pertinent and highly valuable information. Also, if you made it this far, please like and subscribe. You can use options to lock in your desired stock shares purchase price or sale price. For our long-term investors, we will go over simple examples highlighting how you can use buying call and put option contracts to lock in your desired stock shares purchase or sale price. For this example, we will buy a call option at the $120 strike price that expires 30 days from now. Owning this call option will allow you to purchase stock at $120 per share anytime within the next 30 days, no matter where the stock is trading at. For this example, we will buy a put option at the $120 strike price that expires 30 days from now. Owning this put option will allow you to sell stock at $120 per share anytime within the next 30 days, no matter where the stock price is trading at. Long-term investors, if you want to own stock, 1. Hold the option through its expiration date, and it will turn into stock shares. 2. Sell the option, then immediately enter a stock position. Options were created to manage one thing: risk. They can be used to hedge, speculate, or simply as insurance. A very important note for options trading is that investors should clearly define the benefits and risk of each and every position they enter into ahead of time. Although options are important tools for hedging and risk management, traders can end up losing more than the cost of the option itself. Options equal insurance. Earning more profits, larger gains, for more income, the power of options. If you anticipate a significant increase in a stock price, that huge jump will give you solid gains. However, if you want larger gains and more lucrative profits from that stock price jump, instead of buying stock, you could buy a call option where you pay a small premium for the right to buy stock at a later date. Why buy options over stocks? Well, relatively speaking, options require a smaller investment than purchasing shares outright. Instead of paying the share price multiplied by the amount of shares you would like to buy, you simply pay the option price. This unlocks the potential to earn income with a much smaller investment. Investors can buy options that earn more money when the price of the underlying shares increases, or sell options that earn money from premiums collected. Now, let's look at some general examples of how options use less capital but generate bigger returns. Remember, options trade in contracts, so we'll break down some examples of how much you can earn when buying and selling an option contract. Disclaimer: these examples are based on past performances and experiences. Furthermore, they are not indicative of future results. These videos are for educational and entertainment purposes only. Any content used for our videos should not be construed as financial advice or a recommendation to buy or sell any sort of security or investment. To purchase one contract, how much would it cost? Well, for this example, if you buy a contract at $1.11. Now remember, one contract equals 100 shares. So this trade will only cost $111 in capital and buying power. Now, let's say we sell that contract at $4, which is $400 that you earned from this trade. That's a $289 profit. To purchase two contracts, how much would it cost? Well, for this example, if you buy a contract at $1.11, now those two contracts equal 200 shares. So this trade will only cost $222 in capital and buying power. Now, let's say we sell those contracts at $4, which is $800 that you earned from this trade. That's a $578 profit. To make things simpler and understand how options can be super lucrative, please note, rule of thumb is whatever a stock does is times 100 in the options market, which is why options generate bigger returns and are more lucrative. However, if trading options incorrectly, then you can lose just as much or more than you earn. So be careful, do your research and due diligence, but most importantly, learn how to trade options thoroughly and fully first before you start trading. Our Trading Academy content will teach you how to trade and be a master trader, generating consistent profits in no time. It's our better trader guarantee. Now, let's compare this options P&L, profits and losses, to our previous example of buying a stock at $120 per share that increased to $135 per share. If you buy 100 shares of a stock that costs $120 for each share, that's $12,000 in capital you'll need liquid for a stock trade, as opposed to the option play, which only costs $111 in capital per contract. Your P&L for trading those 100 shares at $135 will only be a $1,500 profit gain. But if you were to use that same capital, $12,000 of your buying power, to purchase those option contracts at $1.11 each, then not only would you have to commit less capital, but your profits will be much higher. You could buy about 108 contracts for $11,988 at $1.11 each. And remember, you would have sold these 108 contracts for $43,200 at $4 each. That's a profit gain of $31,212. In this example, that's a stock buying profit gain of of $1,500 versus an option buying profit gain of $31,212. Now, obviously, options can be way more lucrative. Thus, options can use less capital but still generate bigger returns. Benefits of buying options versus buying stocks. Less capital plus less risk. Remember, think of buying options like buying insurance. If you have insurance and the worst happens, you total your car, you have to use less capital for the insurance company to replace your car, typically paying your small desired deductible. Think of this as an options premium, as opposed to not having insurance at all, where you would end up having to pay the full price yourself. Think of this as buying fully priced stock shares, which is rather expensive. Now comes the big reward of having insurance, options. If you have a good claim strategy, then you get a much larger payout from that insurance claim than you would from not having the insurance, buying the stock. So, options have less capital plus less risk equals a big reward. But wait, options are risky. Options are not risky when trading options the right way. Trading options are less risky than trading stocks, if done correctly and strategically. You just have to be educated, experienced, and know what you are doing when trading options. That's where Mo Investments, Trading Academy, and exclusive membership access comes into play. Our content and guidance will show, teach, and thoroughly explain how trading options can be less risky but generate bigger returns. Now, let's discuss some key terms before diving into calls and puts. Strike price, the agreed upon price at which the stock will be bought or sold. Expiration date, the specified date at which the option contract will expire. Understanding call and put options. A summary of how options function. There are two types of options that can be bought. This is considered being long on a position, and sold. This is considered being short on a position. A call option and a put option. Now, most investors are buyers or long on positions. Thus, for buyers of a call option, you are bullish on a trade, which means you anticipate the stock price to increase. For buyers of a put option, you are bearish on a trade, which means you anticipate the stock price to decrease. These are some of the fundamentals for trading options. Now let's take a deeper dive and discuss the various options more in depth. First, we will discuss the long call option, typically one of the first entry-level option trades people will place. The long call option gives an option holder the right, but not the obligation, to buy shares of stock at an agreed upon price on or before a specified date. As a call buyer, being long in a position, you have to pay a premium. You want the underlying price to increase. Your maximum gain is unlimited as a call buyer, given the fact that there is no ceiling for a price to increase. Your maximum loss is the premium you already paid for buying the call option. You get to a break-even point where your loss is zero if the price of the option should increase to cover the strike price, in addition to the premium already paid. At expiration, your typical or desired goal is for the long call option market price of a stock to be greater than the strike price. This is called being in the money for a profit gain. When a long call is ITM, you should gain more profits, and this should be a profitable trade. Thus, you should always take the profits because you never want to risk an in-the-money ITM trade going red, being out of the money and lose your profits. If the market price of a stock is less than the strike price, then you should lose money because the option is now worthless and out of the money. At expiration, if the market price of a stock is equal to the strike price, then you should have a small loss of the premium paid because the option is at the money. What are your choices as a call buyer? To exercise and buy the underlying when the option is in the money. Trade the option also when the option is in the money. You can walk away and not exercise the option. What are your two main objectives as a call buyer? To speculate on the potential rise in the price of an underlying instrument, to hedge a short position on the same underlying. Long call strategy overview. Market direction, up. Time decay, typically against us, especially for short expiration dates with only a few days or weeks until expiration, but rarely can benefit us if high volatility or a big increase in price movement. Note about option Greek theta. As expiration approaches, there will be time decay. It's a certainty. Implied volatility, from low to high, increasing. Risk and reward. Investment bank risk level, low. Reward, an unlimited max profit. And risk, a max loss of the premium or price paid, cost of the option. Break-even point, strike price plus cost of the option. When to trade, when you want to make a leveraged bet that a stock will go up significantly. Tips for the long call option. Choosing a further in-the-money strike will provide traders with a better probability of profit, pop. Choosing a further out-of-the-money strike will give traders a better potential return on investment. Buying call options is a straightforward option strategy to go long with a limited downside and an unlimited upside. This effect of an unlimited profit, limited downside, and lots of leverage that makes the long call option strategy so interesting. The most important thing to remember when buying call options is to size the position appropriately. There is always a chance that the total amount of money spent on the long calls will be wiped out due to the call options expiring worthless. Therefore, buying call options is a risky strategy. Not as much capital should be committed to long options positions, particularly those that are out of the money, than long equity positions. Next, we will discuss the short call option, which is considered to be a more advanced option trade because it's more risky and has more restrictions due to different permissions or provisions needed by your brokerage institution that require higher level approvals before this type of trade can be placed. Short call option. You assume the obligation, not the choice, to sell the underlying when the call buyer exercises his option. As a call seller, being short, you will receive a premium for that obligation to sell from the buyer of the option. You will be willing to see the underlying price decrease. Your maximum gain as a call seller is the premium already received. Your maximum loss is unlimited. You reach a break-even point when the price of the option increases to cover the strike price, in addition to the premium already paid. Note, there are a few ways to short options: naked, covered, or spreads. For the purposes of this video, we will focus on naked options, but briefly explain covered options, and we will discuss spreads in another video. A naked call option does not require the seller to own the underlying shares. A covered call option is an option strategy in which the seller of a call option owns the underlying shares of the contract. In this situation, the seller is able to limit their exposure to risk by selling their shares if the buyer exercises the option, as opposed to buying them at market price and taking a loss on the sale of a naked call. There are three main reasons why an investor might sell covered call options. First, to make additional income, sellers earn premiums on each covered call they sell. Second, to hedge against their investment. If the price of their shares decrease, they can earn some of the money back from their premiums. Third, to sell their shares. If the price of the underlying asset increases and the buyer exercises their option, the seller can immediately sell their shares, potentially at a profit. At expiration, if the market price of a stock is greater than the strike price, then you should lose money because the option should be deep in the money, thus gaining more value and becoming very expensive to buy back. At expiration, if the market price of a stock is less than the strike price, then you should gain profits. Remember, if you have a profitable trade, always take the profits because you never want to risk losing profits. However, contracts can expire worthless, thus time expiring may increase your short profit gains. When short selling, you want contracts to be out of the money and worthless at expiration because the goal is to buy the contract back cheaper or when they're worthless. At expiration, if the market price of a stock is equal to the strike price, then you should have a small profit of the premium received. This is what short selling a call should look like at expiration. If you want to gain profits, your strike price should be above the market price of the stock, meaning the stock price should be going down. What are your choices as a call seller? In case the call option is exercised by the buyer of the call, then the seller has the obligation to deliver the underlying with a potential unlimited loss. If the underlying price decreases and the option expires worthless, then the seller will keep the premium as the maximum profit attributed to this trade. What are your main objectives as a call seller? You capitalize on a bearish strategy using theta, time decay, and declines in the underlying asset price. Plus, you increase the yield by selling calls against positions held long. Because options have a limited lifetime and expire, you must sell options before they become worthless. Short call strategy overview. Market direction down. Time decay typically benefits us but can be against us if high volatility or there's a big increase in the price movement. Note about option Greek theta. As expiration approaches, there will be time decay. It's a certainty. Implied volatility from high increasing to low decreasing. Risk and reward. Investment bank risk level very high. Reward a max profit from premium earned. Profit received from premium sold at. And risk a potential of an unlimited max loss. Break-even point. Strike price plus premiums earned. Premiums you have received. When to trade. When you want to short a stock because you predict the price will drop significantly and want to collect a premium while it's overpriced. Tips for the short call option. Choosing a further out of the money strike will provide traders with a better probability of profit. Pop. Choosing a further in the money strike will give traders a better potential return on investment. Short selling calls can be a great way to seize the option premium for easy profits. With short calls that are out of the money, you can make money if the stock moves up slightly, does nothing, or declines dramatically. Moreover, sharp decreases in volatility and decreases in the price of the underlying asset, in addition to theta, time decay, all of which can make selling calls very profitable. Despite the fact that there are technically 3 ways to make money with short calls, it's important to remember that selling calls foundation is still a bearish options trading strategy at its core and heart. The max loss for short calls is theoretically unlimited, but in exchange, the likelihood of profit is very high. Always remember, other factors of an options price can inflate prices, like volatility. Thus, sharp increases in volatility and the price of the underlying asset can wreak havoc on a short call position. Basically, when you short sell calls, you mitigate the risk of a widespread market crash, wiping out the underlying asset. Important side notes. Before we dive deeper into options, I want to detail some high-level instances why you should think of options as insurance, and how options can protect your investments based on who's willing to take on your risk. Buying puts specifically should be thought of as buying insurance. In case the underlying asset crashes, a lot of hedge funds and institutions can only maintain so much long exposure in the market, and instead of trimming their positions, they will often buy puts to protect their downside exposure. This also creates a demand for puts, and it just makes them more expensive. The downside risk is simply larger for most people than the upside risk. Because most market participants are long buy side, thus buying puts will protect your positions if a huge sell-off occurs or the market crashes. Both can happen. Also note, if you buy an option as a way to protect a stock investment, then you are paying the option seller to take on your risk. Options are not meant to be more risky. However, if you want more money, then they can be more risky. Thus, most investors know more risk equals more money. Visit us at moinvestments.org and sign up to join our trading community now. Become an elite trader, earn consistent income, and build your generational wealth executing profitable options trades. Stay tuned for more Trading Academy content. We can't wait to see you in the next video. And don't forget, please like, comment, share, and subscribe. To join, just go to moinvestments.org/collections/all for membership offers and info about how to sign up to start your investment journey now. Follow us at Mo Investments on all social media platforms to see profitable trades, investment insight, profit performance postings, as well as free giveaways. Video disclaimer: Mo Investments is for educational purposes only. We do not force any investments or trades, and you are to use your own due diligence when investing or trading. Results are not guaranteed. Past experiences are not indicative of future results. Always invest and trade with an amount that you are comfortable with losing and that you will not jeopardize yours or someone else's financial well-being. Mo Investments is not a financial or investment firm, and all signals are to be used knowing they may or may not be accurate. These videos are for educational and entertainment purposes only. Any content used for our videos should not be construed as financial advice or any recommendation to buy or sell any sort of security or investment. Please consult a professional financial advisor before making any financial decisions. Investing in general and options trading especially is risky without proper research, knowledge, and due diligence.